Thank you, everybody, for joining us. Thanks, Jackie. Always good to see you. Welcome to our Bridge Star webinar here today, where we do, in fact, try to help you find ways to originate more loans, help grow your referral base. Glad you could all join us. Good morning or good afternoon, wherever you may be. Again, my name is Jamie Gilso. I'm joined with Jackie Weed. Together, we help run and manage the TPO channel here at American Heritage Lending. Jackie, it's not noted, but is also our head of credit. So we're happy to talk about scenarios of any kind during this conversation while we're here today. Just a quick touch on the agenda. We'll briefly just tell you about who we are and what we do, why you may want to partner with us. We'll give you a quick overview of the 2026 housing market. This is not meant to be an economic presentation, just kind of touch on some of the opportunities available in the market. And of course, how unique product, such as our Bridge Star program, where we utilize bridge loans to buy new primary residences, can help you hopefully realize some of those opportunities and, of course, create new referral sources. So real quickly, American Heritage Lending was founded in 2008. We are based in Irvine, California, although we do have operations teams and sales folks throughout the U.S., so all markets and time zones are serviced well. And just as importantly, our management team is made up of really seasoned non-QM professionals. This is not our first time doing non-agency lending. We've been doing this for actually decades. So a couple of years ago, we weren't paper lenders who are now non-QM lenders. We understand credit very well. We're partially owned by a large fund that securitizes our production. So it really gives us a lot of bandwidth in terms of products as well as exceptionability. We're very big on our staff and their commitment to your service and customer service. Here's a quick picture of them. And again, there's a lot of seasoned folks in there that give us a lot of great background in credit. As a result, we have very flexible underwriting for make sense loans. And a lot of our account executives can help you structure unique scenarios. We are only a non-QM lender. We have a full range and full plate of non-QM products. We won't get into those today, but your account executive, of course, can help you. Everything from bank statement loans with expense ratios as low as 20%, DSCR loans up to 85 LTV, a strong 5 to 10 unit product. And we really, really do well on condos and non-workable condos and condotels. Those things are approved in-house. So a lot of flexibility there. Just from a licensing perspective, you can see we're covered in most states. We're licensed in some capacity in every state except the Dakotas. Business purpose only in New York, Missouri, Arkansas, and of course, Hawaii. We're one of the few true non-QM lenders with a full TRID license in the great state of Massachusetts. Go Red Sox. Sorry, shameless plug. All right, so why partner with us? Again, we do a full suite of non-QM products. We touched on briefly. Roughly 35 to 42% of our business each month is an exception to our guidelines. We have what our customers tell us is probably one of the best portals in non-QM lending, where you can do everything right there. Register, lock loans, disclosures with no human interaction, order your appraisal, etc. We do offer delivery across all channels, not just wholesale, but also correspondent, non-delegated, full delegated, as well as table funding for business purpose loans. And we've got some of the best-in-class turn times in the market, particularly at the upfront underwriting stage. So a lot to offer there. So again, real quick, just an overview on the housing market for 2026, some of the potential opportunities. Here we have the little, the normal cast of characters, that give us stats. Zillow, of course, being a big one, and NAR. Everybody sees a modest recovery this year, it looks like. This is kind of consensus. Not necessarily a boom, but a modest recovery. That's an important caveat for later on how a bridge loan can help. Still will be over 4 million units sold this year. So that's still a, even in a quote unquote not boom market. Well, there's a lot of transactions for all of us to grab a few loans from, I would think, based on that number. Growth seems moderate, but okay, it is growth. And you see some things that drive this, affordability is somewhat improving. Thankfully, mortgage rates have eased a bit. We all laugh at this slide because lately they've moved pretty quickly. This slide could be accurate. It could be grossly inaccurate, and that could change in the next 15 minutes. But they have come down a bit from the highs. One other component is we see, there's no secret that there's a record amount of equity in the U.S. home market, in U.S. homeowners today. And a lot of folks have some really low rates on their first mortgage, which we know. And in the past, and many still may be hesitant to give up that rate. But as we say here, there's always a loan, right? There's always a loan. So, people buy houses for many reasons. And here are some of those. Marriages, unfortunately, don't always end well, and people need new homes. Families grow, thankfully, in the US, and we need new homes. People, age gracefully and maybe want to downsize. People move, job relocations, etc. So as a result, the first mortgage rate may not matter. And of course, as people maybe want a new home or a larger home for a new family, they're not as attached to that low rate anymore. So we continue to see that market open up a bit. So in a nutshell, we look like we have modest growth plan this year. Loan sizes should be decent. Home prices are up, which is better than the alternative. And again, there's plenty of opportunity there, particularly if you deal with realtors, if you're really trying to grow your referral business and your purchase business. So what are some of the challenges based on that market and some of these opportunities? Well, of course, down payment. I don't need to tell the originators on this call that down payment can always be a challenge. Many borrowers, if they do, are lucky enough to participate in that record amount of U.S. home equity. They need that equity to buy that next house. Of course, qualifying for everything at once can be a challenge. So let me just pause for a second, folks. Please understand that the complexion of our borrowers for bridge loans are agency borrowers. So I know we're here today as a non-QM lender with some of the best non-QM products in the market. But this particular product, our Bridge Star loan, these are generally agency borrowers, very well qualified, but they're facing the challenges you see on the screen in front of you. So they've got great credit, but maybe they can't afford 2 mortgages at once. So maybe they can't afford their current mortgage plus the mortgage they want to buy, plus the HELOC to have the funds for the new house. So, it's not easy to qualify for 2 or 3 mortgages at once. And then there's other pieces, right? So based on the market, some markets are stronger than others. Not every seller will take an offer with contingencies where the buyer has to sell their current home. And another thing is, and that's why I touched on one of those earlier slides, when a market is growing modestly and you're selling your current home, it may not happen overnight. And if you have a little flexibility to help you really maximize that value, that resale value, nothing would probably make you more upset if you were selling your current house and you had to sell it quickly and leave 5% on the table. Certainly not going to help the next purchase at all. So our bridge loan really helps with a lot of those concerns. And again, our bridge loan is just what this says on the screen. It's a solution. I'm pretty sure no borrower wakes up in the morning saying, I want a bridge loan. They got here because they're literally kind of stuck in the middle, and they're looking for a solution to maybe one of the challenges we just displayed. So this is a great loan for really a lot of those things. Hot markets, people again want to make offers without contingencies. BridgeStar is great for that. New construction, you need some flexibility in timelines. Maybe the house isn't quite finished for 5 or 6 months. And again, homeowners with a lot of equity that they want to utilize for the next purchase. This is a great referral builder, folks. It really is. I mean, you go talk to realtors, they love the idea of a bridge loan. They've probably all had a transaction in their career that probably could have worked out had they had access to a bridge loan. Liquidity on a bridge loan basis isn't always readily available nationwide. Obviously, home builders and developers, and even financial advisors and CPAs. You'll see one of the live scenarios, or not live, but actual scenarios we funded that we'll display here was actually a retired couple. That was a move down situation. So there's a lot of referral streams that can come out of bridge loans, because ultimately, again, what are you offering your borrowers and your referral sources? A unique solution for a problem. So we offer bridge loans in a couple ways. Okay, we offer a standalone product, and we offer a simultaneous product where we do a bridge loan on the departure residence, and we also do the loan on the new acquiring property. So it can get a little convoluted. So let me just start by saying, on our bridge loans, they are meant solely for the purchase of a new primary residence. So the acquiring property should always be a primary residence for our BridgeStar product. Now you'll see where we can use the bridge loan portion to maybe leverage other collateral, but the acquiring property should always be a new primary residence. Okay. So our standalone product, it's up to 70 LTV, and our simultaneous is up to 75. On either one of these, the way this program works is, on the departure residence, we're going to pay off the first mortgage, the current existing first mortgage, and then give the cash out needed towards the purchase of the new house. It's a 12-month term with interest-only payments, and those payments are deferred. So that's important for a few reasons. Number one is there's no cash flow pain for your borrower while they're going through this transaction of moving in between houses. So on a primary residence, we're up to 70 LTV. So we would, again, pay off the existing first, give cash out up to 70 LTV, interest-only payment, 12-month term, payments deferred. If we are doing the new purchase on the new primary, we'll go to 75 LTV on the bridge portion on an owner-occupied residence. We will now also offer the bridge option on second homes and investment properties with lower LTVs. One of the advantages if you take this simultaneous bridge loan is when we underwrite the purchase of the new home, we deduct the payment from the bridge loan out of the DTI. So it really opens up your buying power for your borrower, right? So they can access equity in the current home, and on that loan, there's no payment. The payment is deferred, actually. On the new house, if we do the financing, we take that payment out of the debt ratio and go up to 90 LTV with no MI. So a lot of buying power there on that new primary if they in fact need it. You can see loan amounts up to $2 million. We make exceptions to go higher case by case. Minimum FICO 680. Some of the highlights I'll touch on again. It is for the bridge portion is for departing residents. Okay, and that can be based on if it's standalone, that departing residence is the departing primary. We do have examples where people are taking a bridge loan on a second home and selling that second home to help finance the purchase of their new primary. Jackie just saw one of those 2 weeks ago, I think she told me. So 12-month loan, interest-only payments, payments deferred. It's available in all states that we're licensed except Texas currently. And the important part, just touch on this and do a sales digression for a minute, pardon me, is it does create multiple referral streams. So here's let me, just touch on that for a second. Again, we got here because we have an agency level, high qualified borrower who is stuck, has a bit of a squeeze, and wants the new home. So we're providing a solution. So that borrower should hopefully, assuming they want this and want to do these things, to get a bridge loan, they should be happy with you as the originator. But there's probably some other happy folks besides the borrower. The realtor involved on both transactions, right? So you're dealing with two realtors now, probably. You've got maybe three realtors, right? You've got the buyer's agent on the new primary. You've got the seller's agent on the new primary. You've got the listing agent on the house they're leaving. You probably can have contact with all those folks now. And if you pull this loan off that nobody else can do, they might want to talk to you again next time they have a customer, right? So there's just a lot of potential referral streams that can come out of bridge loans. It's not just this one transaction. Again, some program highlights here. On the bridge portion, on the bridge loan itself, and we do that departure residence, there's no ability to repay, no income verification, no DTI. So those are really, really strong factors. Again, with that 12-month term, people can actually realize the full value of their home when they sell that departure residence. So I'm going to pass the con to Jackie because she's the one that actually makes the tough decisions on some of the credit we do. And just touch on, a couple live, well, not live, pardon me, but actual bridge loans simultaneous that we funded.
Thank you, Jamie. Hello, everyone. So this particular example was a bridge loan that we did on a primary departure residence, single family. The value of the property was $1.5 million. The loan amount was $355,000. That's all the borrower needed, with an LTV just under 24%. So the new loan, we did this simultaneous. It was a 24-month bank statement loan on a single family residence. The borrower was actually moving up a little bit, a $1.2 million loan amount. So we did this loan at an 80% LTV, but we have a really cool stacking option where we're able to stack points for the borrower to buy down the rate or use for closing costs, or in today's market, their portion of the realtor fee. So the LTV was actually 82%, but we priced it at 80%. So on the base LTV, we had a 691 FICO, but what was really important about this is the $4,000 bridge loan payment was excluded from the borrower's debt ratio. So he was able to qualify for the acquiring property without having to include the bridge payment.
Yeah, thanks, Jackie. That's a great example of, you look at that and say, well, why would you need a bridge loan? They can't qualify for that new purchase otherwise. They needed that equity from the current house, and that payment combined with the new payment on the new house tripped the DTI. So the bridge loan, by omitting that, opened up the DTI. And then Jackie touched on a stacking feature. It's really unique. In this case, that $1.2 million loan, let's assume or pretend those 2.5 points were BPC or broker fee, right? So broker fee of, I don't know, $30-some thousand. That's financed into the loan. So the borrower does not have to bring those funds to the closing table. So your broker fee can be added to the loan amount in a purchase, which is kind of cool. And to Jackie's point, it doesn't affect pricing. This was an 82 LTV deal that priced at 80. Awesome. All right, let's go to another one.
I have a quick question. Speaking of pricing, let me interject because we have a question.
Sure.
He has asked us, what is the cost to do both types of bridge loans to borrower?
Sure. Good question. So if we are doing the simultaneous piece, okay, where we're also doing the new purchase, on an owner-occupied residence, the bridge loan is 8.5% interest rate and 2 points to AHO. If the departure residence is a second home, it's 8.75 and 2 points. And if the departure residence is a investment property, which again, with the funds are to buy a new primary, then the rate is 9% with 2 points. If it's a standalone bridge, where we're just doing the bridge and the departure, and you're either taking the next purchase somewhere else because they can qualify, or maybe they're just paying cash. We do see that sometimes. About 12% of our bridge production is standalone, just so you know. That's 9% with 2.5 points to AHO. So these loans are usually in the books for, well, as you can see, they're a 12-month term. The house is on the market. They're usually in the books for about 7 months or so. So there's not a lot of money in the bridge loan for any of us. It's really the solution and keeping all the referral sources happy to get those next loans. Great question.
Okay. This particular example, Jamie referenced this earlier on. This was actually a borrower that was looking to downsize. So a retired couple, the departure residence was their single family home. We did a loan amount of $600,000 at just under 74 LTV. The acquiring property, we did our All-Star Asset Qualifier loan program using their assets to qualify them for the new loan, which was on an owner-occupied condo. A loan amount of $400,000, just under 68 LTV. Borrower actually had an 840 FICO score. But what was really important in this transaction was excluding that bridge loan payment from their debt ratio calculation. Since we used the asset qualifier program and they were looking to downsize, debt ratio was really important in this loan, and keeping it down, by using the bridge loan and excluding that payment helped the borrower get into that new property.
Yeah, that's pretty cool, Jackie. And again, here's, you think of this borrower who's really done everything right in their lives, right? 840 FICO, retired, high asset base, good equity in the current home, want to have even better equity in the new home. Literally done everything right, financially in their lives, and they're stuck in the middle. And so here you go. It's a combination of both asset qualifier, where we amortize their qualifiable assets over just 60 months. So that's a pretty strong asset depletion calc. 60 months. Just for the record, for every $1 million you have in depletable assets, it's about $16,000 a month in qualifiable income. And combine that with a bridge loan, right? So you're using asset depletion to maximize income as well as deduct that other payment from the DTI. Pretty cool. Jackie, what was that one you had recently where we did somebody was taking equity out of 2 houses. We did 2 bridge loans to buy a new primary.
100%. So we had a departure primary, and then it was actually an investment property. So the borrower owned an investment property. We did a bridge loan on the investment property, a bridge loan on the departure primary. So we did 2 bridge loans for the borrower to purchase a new primary. So they were actually moving up, buying a bigger primary residence, and we were able to finance both of those, the investment property and the departure primary, and assist the borrower in purchasing his new primary.
Yeah, that's great. So, again, some real creativity here. I'm pretty sure all the realtors were happy there. You had, two new departure primaries, 2 new departure properties that had to be listed, a new purchase, a lot of referrals. And then I know we had one recently where I think we had somebody that owned a dental practice in one state, and they were buying a house and getting new dental practice, God, halfway across the country, and made, did that bridge loan on the current primary, did the new purchase, got creative on the income with the dental practices. Lot of great opportunities here, folks, with bridge loans.
Jamie, that one was a really prime example of a very good borrower that was stuck because of the sale of, the dental practice that he had in actually on the West Coast, and he was moving to the East Coast and purchasing the new dental practice, but he was not able to really get financing because of everything that was going on, but we were able to assist him. And surely we like medical professionals, and we look for ways to help them as well.
Yeah. Good stuff.
I did have one other question. Let me ask this for you. Move on. And it says, what do the rates look like on like a purchase loan? And then second to that is there an EPO on the purchase loan?
Yep. Great question. So, right now we've got some rates in the 6s based on LTV and FICO. Generally we're seeing plenty of our rates within a quarter of agency. So it's not some egregious spread. I'm sure if you're an LO that generally deals with agency customers, you hear non-QM, you're thinking a 9 handle or something, and that's not the case on the majority of non-QM products. I would dare to say, Tony, and I don't have pricing up, but our 90 LTV pricing is probably the strongest on the street in non-QM, and we don't have MI. So when you start thinking, and our jumbo is exceptionally strong because we don't have the LLPAs that agency has. So, based on any given loan, a jumbo at 90 with the lack of MI, we might be priced better payment-wise than some agency loans. So in terms of pricing, we've got plenty of rates in the 6s to answer that question. And in some cases, we're right there, with agency based on the scenario. In terms of EPO, so we have what we call a 6-payment EPO. We do want to see 6 payments made, please. And so I think that very astute loan originator was already asking, if I have this agency client that needs this solution and they do the bridge loan in the new purchase with you, when could we refinance them? And so, we talked about this is a great referral source and a great pipeline builder. Well, we see this, I would say, often, this scenario where you have that solid borrower, they need our bridge loan, and they need our acquisition loan because most lenders will not exclude our bridge loan payment. We will. So they end up with, the bridge loan and our quote unquote non-QM loan on the new house. Well, then real life kicks in, right? If anybody on this phone's ever moved, that doesn't happen over a weekend, especially just think of the scenario. You've been in this house so long, you've got a lot of equity. Take it from someone who knows. Yeah, I'm half joking, but you ever move out of a house that you've been in for a long time? There's a lot of boxes that get unpacked at the next house. And so next thing you know, 3, 4, 5, 6 months go by, finally the last box is unpacked, at least hopefully. They've probably sold the primary. And we see plenty of people around month 9 or 10 tee up a refi. And that loan originator now ended up with really our bridge loan, the new acquisition loan, and a refinance 9 to 12 months later. And a bunch of happy realtors and referral sources.
Jamie, here's a question for you. This is a valid question. What if that home doesn't sell in the 12 months?
So we don't, thankfully, knock on wood, and I'll use hardwood if you can see me hitting the screen, my own head. We really don't see that much. We've got some LTV protections there. We generally, thankfully, the people do in fact want to sell the house. And, that time frame in, most markets in America gives them time to sell the house. If not, we can look for extensions case by case. We're going to want to see that, there is truly an effort that they're trying to sell the house. But, thankfully, Tony, that it usually does not come to that.
Okay. Okay. Let's see. I have another question here. Tracy has a couple really good questions. What's the max LTV in departing residence? If we haven't mentioned that on either of the two fronts.
On a simultaneous, where we're doing the new purchase and the departing residence is a primary residence, it's 75. If that departing residence is a second home or an investment property, it's 60. And if we're doing just a standalone bridge on a departing primary, it's 70 LTV max.
Okay, and do they need to purchase? It says here, do they need to purchase new home? And also, can it be a senior who's downsizing to like a senior rental community?
No, it has to be used towards the purchase of a new home.
Okay.
And we do want to understand the characteristics of that, because we want to see the funds from our bridge are in fact going towards the purchase of a new home. So if we're doing the new purchase financing, then we'll probably do simultaneous underwrite. If we're doing a standalone and it's a purchase and we're not doing the new loan, then we want to see the purchase sale contract executed on the new property, etc. Jackie, and if I'm out in left field, as always, just yanking you.
You're right on.
That's strange. At least on guidelines.
All right, perfect. Well, I'll let you go ahead and continue on. I apologize.
Yeah, no, these are great. No, please, these are great questions. These are really, really good questions. Okay. So if you want to start selling this product and expanding your book of business and maybe having friends with new realtors, etc., we've got some resources to help on our webpage that Tony mentioned, ahlendtpo.com. We have a bridge loan calculator. You can see there, if you can, see in that screen a bit, you just, fill in your blanks in terms of departure residence, new construction, and it'll give you some information on, how to figure those numbers out and see what you may need for equity and what the new purchase can be positioned as. So it's pretty cool. Private label marketing. So Tony mentioned we have a really great, within our webpage, we've got a great business builder or brand builder kit within our broker toolkit. And you just can go in there and really drop your email. And this, you can see John Smith, this handsome devil, went in there, dropped his stuff in there. All you need is your email. We'll pull the rest for you online. And now he has that bridge loan and he can go give this to his realtors. We're not going to do retail loans, right? So we're going to try to give you these tools so you can go solicit this business and, hopefully you'll give us a shot at the loan. In that light, if you are looking, again, to build your realtor business, we have many loan originator partners that are account executives. Do these presentations to realtors, both realtor offices and realtor trade association groups in conjunction with the loan originator. Again, we're not going to take the loan. We can't. We're TPO. So we're happy to present as your partner, if you would like, on this product. And then, hopefully you can get some referrals out of it. Okay, moving along.
Okay, I have a question for you since we're on a roll of questions. It says, just as a confirmation. So to confirm, a recast is an option after 6 payments and would not incur an EPO?
So a recast, we do not do recasts. So a refinance after 6 payments technically does not incur any EPO. Yep.
Perfect. Okay. We did have someone, I'm going to put this in here as well, just to let you know, they were asking for the website address, and it's on here as well. But just so you know, it's www.ahlend, as in ahlend, tpo.com. So it's also on this presentation, which we'll send to you and so forth. But again, it's www.ahlendtpo.com.
There really is a slew of resources on there to help all of you, try to originate more loans, including a bunch of private label marketing stuff that you can utilize. So, again, in closing, industry, forecasts a good year in home sales with over 4 million units. The locked-in effect of people not want to give up the rate that they got during, the early 2000s is starting to subside as life events take over, as it does for all of us. And you know, this Bridge Star loan really gives you, the originator, really something unique to go out and offer, not just your customers, but your referral bases, both old and new. Not everybody has this product. You know, most of our competitors, for the most part, don't have this product, which means, you know, most of your competitors don't have this product. So it's really a great door opener, and we encourage you to utilize us to help you open those doors with private label marketing, account executive presentations, et cetera, et cetera. So I know we've had some really good questions, and you know, we talked about the ability to do really a few loans for any given customer, but really like to open it up to any questions in any scenario. Again, you know, we do this stuff all day, not just bridge loans. So, you know, condos, non-mortgable condos, people less self-employed less than 2 years, foreign nationals, you know, 5 to 10s, ADUs, ACVs. You know, we love acronyms. OMG. Anybody have a loan to talk about?
Okay, we have some other the big questions here.
Sure.
Let's see. Okay. Some of them we have answered, so let me double check there and see. Okay, I don't see any others that have not been either answered, or I don't want to become too redundant. Let me see here. I don't see anything else at this moment. Let me see here. Oh yes, there was one in here. Let me see here. Asking about like exceptions on property types and so forth. That you mentioned earlier. Is that something that you can expand upon?
Sure.
Jackie, if you want to,
Sure.
you don't want to see some of this stuff.
Yeah, a lot of times we will see properties that are rural or rural and in excess of 10 acres. Our guidelines allow up to 10 acres, but we will see properties that are, you know, excess acreage. That is something that we can potentially entertain. It's appraisal dependent, but we do make exceptions on those. As Jamie mentioned, we do see a lot of non-warrantable condos and condotels. You know, there's various things that makes condos non-warrantable, but the ones that we see the most frequently are litigation that really isn't a major litigation, or you know, there's an attorney letter that suggests that there's not going to be any exposure to the HOA. Oftentimes there'll be a slip and fall, or you know, somebody in the HOA is suing another member of the HOA, and you know, but it's open litigation that makes the condo non-warrantable. So we'll look at those. We will also look at actual cash value insurance on the roof of a condominium complex, roof only, but that is an exception that we'll look at and make. Fannie Mae is actually going to expand their guidelines come August to allow that, but we've been making those exceptions where it makes sense. So, you know, if we have an unusual property, we could have a 2-unit where it's actually 2 single-family dwellings on the same lot. You know, we can look at those types of exceptions where you've got properties that just kind of don't fit the standard property type. And like I said, we often see the excess acreage, we see rural and the non-warrantable condos, and we are happy to take a look at those. They are, again, appraisal dependent, and you know, we need to see comps that can support the value, but we'll look at those all the time.
Perfect. Thank you for that. We have a question. Let's see if I can, a couple questions by one individual, if I can combine them. So it says, just to confirm, the cost is between 2 and 2.5. Is that correct?
Yes.
Okay. And also, is it broker paid on the first bridge loan or just the primary?
It's borrower paid on the bridge, and it can be either on the new acquisition.
Okay, that makes sense. And return, what's a valid question on any loan, which is good to know. Our turnaround time with a clean file.
Yeah, we have closed loans in as fast as 7 days. If you have a really clean file and you're really cooperative with your account manager, there's no reason we cannot close that loan inside of 14 days or less. You know, it just depends on the interaction that you have with our account manager, and obviously getting us the documentation that we need to get the loan done.
It's understandable. Okay. Let me see here. Oh, good question. Are they able to get comp on the bridge product?
Yes. Obviously we'll hit some high cost pieces, but if we're doing the simultaneous transaction, there is some room opened up there where the broker can make, probably most of their fee on any given loan.
Okay, so for instance, it's asking is, so is this a broker paid product or lender paid? And do we have the ability to make money on both loans as well?
Yes. Yep, absolutely.
Okay, perfect. Let me see where we're at with this next one. We are, by the way, encouraging the questions are coming through, and I'm just trying to go through them as much as possible.
Love it.
They're saying as well, so the borrower paid comp on bridge loan from the departing residence has a 6-payment EPO.
Yes.
Okay. Let's see.
No, pardon me, Tony. Pardon me.
No, there's no EPO on the bridge loan.
There's no EPO on the bridge loan. The EPO was on the new primary. Thank you, Jackie. There's no EPO on the bridge loan at all.
Okay.
If they sell it a week after closing, then that's it. That was just, that's why it is in fact short-term money. So there's no EPO on bridge, just on the 6-payment on the new primary.
Okay. Are appraisals required on both?
Yes.
Yes.
Just making sure.
That's a good question and a good point, Tony. The bridge loan is its own loan. So even if we're doing the simultaneous transaction, the bridge loan is its own loan, its own docs, its own fees, its own closing, its own structure. Granted, it's, to Jackie's earlier points, there's no DTI, et cetera, but it is structured as a separate transaction.
Okay. And this is one, excuse me. Okay. Can you provide an example of a departing residence valued at, let's say, $700,000 with a current mortgage balance? All right, get the papers out, get your calculators. Okay, current, let's see, departing residence, $700,000. Current mortgage balance, $300,000. Can you give an example of how that might be something we'd be able to work with?
Yeah, so I'm going to assume that we are doing, that it's a simultaneous, so at that point, I'm gonna, theoretically max out the LTV on the departure at 75. So if it was a 700K departure residence, 75 LTV is 525,000 would be our max loan size. And you said it looks like they owed about 300,000 roughly currently. So that would leave $225,000 in proceeds that they could apply towards the new purchase.
Minus closing costs for the bridge.
Yep. Exactly. Yep. And, take it a step further. So theoretically, if they were buying $1 million house on the new primary, and after that 225, after closing costs and everything netted out 200, they have 20% down in the new house.
Okay, so here's a question we haven't really addressed yet. Some creative financing. Can you pay off debt with the bridge to qualify for the end loan?
Yes.
If we're doing a simultaneous, right? So if we're doing the bridge loan and the acquiring property, we do allow for debt to be paid off to, to help the borrower debt ratio with the new loan.
Okay.
Great questions.
Yeah, I like the creativity there. Yes. Here's one. Can they get the bridge loan in place and closed while still shopping for the new residence?
No.
So the short answer to that is really no, because we need to see if we're doing a simultaneous, then we really approve both of the loans at the same time, right? So we'll underwrite the bridge, we will underwrite the acquiring loan for that particular borrower, but we do need a contract of sale for the acquiring property.
Okay, just a clarification here. I might have asked, but just to make sure. So on the bridge loan, you said no income verification or DTI. What do you mean by that?
We don't ask for the borrower's employment or income on the bridge loan. So the ability to repay on a bridge loan is predicated on the borrower selling the property, right? So the equity that's in their home is what is used for the quote unquote ability to repay the bridge loan. So we do not ask for any employment or income information.
Okay. And let's see, here was one. What information do you need on a bridge loan application?
We use a standard IRLA. We just don't need employment or income on the IRLA, but we ask for everything else.
Okay. And here's another question, specific, which is good to know is, well, what if the borrower is short for the reserve requirement needed on the purchase loan? Are they able to get money from the bridge to meet the reserve requirements?
Yes. So our bridge loan, the proceeds are, as Jamie mentioned, they're used for the purchase of the new property, but we will finance the reserves in that as well, right? As long as it's within our LTV maximums.
Okay, good to know.
And closing costs. So the bridge loan can be used for down payment, closing costs, and reserves. And in the case of a simultaneous, we are allowed to pay off consumer debt for the borrower to qualify for the acquiring property.
Okay. And somebody just wanted a little bit more clarification because there's always what could happen is, and I think we mentioned this too, is in the incident, which rarely happens, that it doesn't sell in the 12 months. Jamie, you spoke to that earlier.
Yeah. So there's a demand note. It's a 12-month note, but in the couple of times that we've seen that happen, we have the ability to make an extension. Case by case, and not long extensions. But at that point, what we're really doing is working with the borrower to see, why hasn't the house sold? What can we do to help? Really understand the situation. But again, thankfully, most high 90 percentile, the house sells. Here's what we can tell you, Tony. We have no interest in taking houses and or being real estate barons. We just assume everybody, sold their house and paid off the bridge loan, and we all moved on. So we would really work towards helping the borrower do that if it did come to month 12.
Okay, perfect. Let's see here. There's questions. Okay, it's a good one. Does the proposed property have to be under contract, or can they do a bridge on the departing property and then begin to shop on the proposed?
No, we need a contract of sale on the acquiring property.
Okay. And that was the next question. Now, here's a good question. I don't know the answer. Do both properties need to be in the same state?
They do not need to be in the same state. In the case of the dentist that we referenced earlier, his departure property was in Arizona. His acquiring property was in North Carolina. So they do not have to be in the same state. And we see that oftentimes if the borrower is downsizing, as in the retirement example, where they're moving to an area, maybe to be closer to children or whatever the situation might be, and it's a different state.
Okay.
Yeah. Bridge loans are great. We talk about building your referral network. Some realtors specialize in relocations. Some markets are so robust with relocation activity that's what realtors do. Northern Virginia, for example, greater DC burbs, some of the tech hubs, greater Mass with eds and meds. And so that is very common that we see in the bridge loan pipeline, where somebody's moving from one state to the next due to a job move or a life event. So great way, again, to help build your realtor business with the relocation specialists.
This is another question going back about can you start the pre-approval process for the bridge and purchase ahead of time? Would that be?
Yeah.
The only thing you have to be careful of is you'll have, documents that will expire. So credit reports will expire in 90 days, appraisals will expire in 90 days. So you want to kind of be careful of that, so the borrower is not having to pay for a second credit report or a new appraisal or anything like that.
Okay. Let me see here some other questions. Bridge loans in multiple states. Do the LOs need to be licensed in both states?
So yes, or, unless you have an arrangement with another broker, we are okay with the same borrower and the LO being from one firm and the LO being from another firm. We have seen that happen before where the LO doesn't have licensure in both states, but they, they have another firm that they have referred one of the loans to, and we can be okay with that. But you do have to be licensed.
Okay. We got a couple other questions here coming through. Talking about, let me see. Okay. What if the borrower intends on selling the property, has a listing agreement with the realtor to list it, but wants to hold off on putting on the MLS until they move out so they can paint, recarpet, stage, prep, etc.?
So we'll allow up to 60 days. So if we have a listing agreement, dated today, but they're not putting it actually live until June 15th, we're okay. As long as it's within 60 days. And we do recognize, that folks want to spruce up the homes to get the most on the sale of that home. So we will allow that up to 60 days.
And do we do pre-approvals for the bridge before the buyer makes an offer on that new home?
I mean, we surely can. Yeah.
Okay. Let's see here. I think we're just talking about this as well, just to make sure the licensing is what if the loan officer is not licensed in the different state, that the bridge would be required, but is licensed in the state of the new purchase?
Mm-hmm. So if you have someone that, in the state that the departure residence is in, and you can, kind of co-broker with that LO on the bridge loan on the departure residence, that's fine. And you can be the LO on the acquiring property. If not, we can look to assist you ourselves on the departure residence if you have no referral and you're not licensed.
Okay. And here's a question is, are you seeing more full doc or non-QM on bridge loans simultaneous closings?
So on the acquiring property, honestly, we probably see more bank statement loans on the acquiring property. We do see our share of full doc loans, but we do see a lot of bank statement loans, and our bank statement analytics are really strong. As Jamie had mentioned earlier, when he kind of ran through some of the products that we offer, our expense factor goes as low as 20% on our bank statement loans. And typically we see small business owners. So, having the opportunity to do a lower expense ratio on the bank statement loans is quite helpful for some of those small business owners.
And appraisals expire in 90 days, not 120?
Yes, our appraisals expire in 120 days. My apologies. Credit expires in 90.
Credit in 90. Okay, thank you for the clarification. These are some really good questions. Thank you, everyone. Can you do a bridge to purchase on investment properties?
You can do a bridge loan on a departure investment property. However, the acquiring property has to be a primary. We won't do investment to investment or second home to second home. We will finance second home and investment on the bridge for the acquisition of a new primary.
Okay. Do you need a CPA letter to go to 20% expense factor?
You do not. So we have a business narrative form that we ask the borrower to complete that tells us about their business. And then depending on what type of business, if it's a service or a product business and the number of employees is really what drives our expense factor. And, if they have 3 or less employees and it's a service business, you're going to see a 20% expense factor in there.
Okay. Do the borrowers, do borrowers need to pay upfront for the appraisal on the departing home?
On the departure residence? Yes. Mm-hmm. And the appraisals can be ordered right through our portal. So, and then the borrower will receive a link, to make payment for the appraisal.
Okay. It says here, just for clarification, a borrower will be paying the departing home loan plus new home monthly payments, correct? The only payment deferred is the bridge loan. Is that correct?
Well, yes, but the bridge loan is on the departure residence. So there is no departing home payment. That would be the bridge loan. So they would only have the payment for the new the acquiring property on their new mortgage.
Okay. Let's see here. Says it's is the fact that you provide a standalone bridge somewhat unique to us? I feel like other lenders just want to do both and so forth. So is that somewhat unique to us?
Yeah, so I mean, I think having a bridge loan program as a non-QM lender is unique in itself, but we also recognize that, you know, there are borrowers that will qualify for agency loans, and they just need that bridge loan to kind of, you know, get them into the new property. So that is why we have a standalone product, recognizing that there are borrowers that you may fit into an agency loan right out of the gate.
Yeah, and it came up earlier on pricing. Again, we understand many of the LOs on this call deal with A paper borrowers, have never maybe even sold a non-QM loan or dealt with bridge loans. Just some perspectives. $1 million purchase right now, high 700 FICO, full doc loan, 80 LTV. Our pricing's around 6.25, 6 3/8 on a 30-year fixed. So I don't know that that's the same as Fannie, but it's not egregious. And to put it in comparison, 90 LTV loan, so $1 million purchase, $900,000 loan amount, 90 LTV, we're just under 7%, no MI. So, if you do need to marry that bridge loan with the new purchase, at least for the time being, that acquisition property rate, I don't think will be egregious based on the scenario.
Yeah. Agreed.
Now, will we pre-underwrite the bank statements in advance of submitting to file to underwriting?
100%. We have a bank statement desk, and you have the ability to upload your bank statements and the business narrative into the portal, which will trigger the analytics to be performed on the bank statements.
Oh, perfect. So
and we can help you with that. Your account executive can assist you, and we have a corporate trainer that can also show you how to upload the bank statements into the portal.
Okay, perfect. Thank you so much. Okay, let's see here. Okay, this is a little bit serious to make sure. So if the bridge is on an investment or second home, there's no DTI in that property. Do you count full debt on departing primary and new primary, or will you use an offset of the departing, assuming that they'll be getting a tenant once they move out?
So we have guidelines for that exact example. There are a lot of folks today that will retain their departure residence and rent it out. So if in fact the borrower is doing that and they have leased it, so we're going to require the lease agreement, the security deposit, and the first month's rent. So, and then we can exclude the mortgage payment or offset the mortgage payment with a rental. But it does have to have an active lease.
Okay. Let's see here. If someone's doing a standalone bridge, why would that be better than doing a HELOC that you were mentioning?
It really depends on the scenario, Tony. I'm sure there's plenty of borrowers where a HELOC may make more sense. But maybe there's qualification issues. At the HELOC stage, maybe the HELOC payment and the by doing a HELOC, you're also keeping your current primary mortgage. So that's another payment, right? So, maybe now all those things combined start to kick out qualifications on the new purchase. But, again, I'm sure there's plenty of scenarios where HELOC may be better suited for some borrowers. But there's plenty of scenarios we see every month where bridge loans are probably the best solution.
Options. Always nice to have options.
Absolutely.
All right, perfect. Let's see here. At this time, I don't see any new questions. Quite a few questions that we've answered. These are great. Let me just double check. Give a few moments if anyone has any other questions. And while we wait for that, and then just kind of reiterate that, yes, this is being recorded. There's probably give it maybe a half hour to an hour. It has to be uploaded to the host website. You'll receive an email letting you know that this live recording is available. And then I'd say hopefully at the end of the day, if not by tomorrow morning, we'll also have this webinar hosted on our website, along with our previous webinars that we've had on multiple topics. We even had a live scenario webinar at one point where people just called in and gave certain scenarios. And we'll have the PDF of this presentation available that you can download as well. And so if you have specific questions, if you have any sort of anything else that you can't, we didn't ask and so forth. If you don't have an account executive already assigned, I'm going to put in here my email address as well that you can reach out to me, and we'll make sure that we'll have the information for everybody. So let's see if there's any other questions. Let's see here. I'm going to double check the chat as well just to see. Nothing in the chat. Let's see here. Any other questions? I don't see anything that hasn't been answered. No? All right. So really quickly, Jamie, Jackie, anything else that you think that we've missed that you want to point out or that we have not covered before I go ahead and end the session?
No, we are happy to look at your scenarios and help you structure loans. We do that really well. So look forward to supporting you.
All right. Well, we thank everybody for joining. Hopefully we have some of our current book of business working with us and our clients. We appreciate your business more than you know. And if you aren't by any means, please give us a chance. Yeah, reach out to us. Let us know what we can do. Like we said earlier, it's all about having options in your pipeline, in your portfolio to help your clients. So we'd love to partner up with you. So we appreciate everybody. And thank you for your time.
Thank you, everybody.
Thank
Take
you
care.
so much.